Where were you on 9/11? I'll bet you remember. I remember where I was. I was headed south on I-95, headed to Melbourne for a business meeting. Got a phone call on my cell phone, one of those big ones we used to have. I got a call on it telling me what had happened, and I went to my meeting, and they had the TV, and we watched what was going on. That changed the way Americans view the world. This generation, or this generation, the next generation, maybe the one before, it affected everybody. Just as when JFK was shot, those people who were living during that time period can tell you where they were when that happened. These events affect the way we see the world. And with the current world we live in and terrorism on the rise, or seeming to always be there, and I suppose if we went back a couple thousand years, the people at that time would say something similar, maybe perhaps a threat in their world. But today, with the 24-hour news cycle, the proliferation of various media outlets, the constant bombardment, if you have the television on, of this just in, wait, don't go away. After the break, we'll tell you about where and when the next major crisis is going to occur, or why things are horrible, or why you got to come back. In fact, you just might as well glue your eyeballs to the television. The rest of your body can leave, but you need to keep your eyeballs on the television. All of that has changed the way people respond to these events. So when we look at the potential for another terrorist attack, most people agree that it can happen or probably will. And the next statement usually is, but we don't know when. And at the same time, we can be prepared and not just throw our hands in the air and say, well, it's just all one big crapshoot anyway. So no, nothing dismissive or cavalier about that should we take with our investments. Now, if I ask you to think about this, let's say you're invested in the market and we have another major event. Would you pull your money out of the market when that happens? The answer should be no. Well, what do you mean, David? You've just got to respond. In fact, if I hire an advisor, isn't that their job? Nope. In fact, part of an advisor's job is to keep you from doing that. So what should you do? Do nothing? No, I didn't say that. I said I don't want you to pull all your money out of the market once the events happened. The time to be prepared, of course, is before it happens. In Florida, we get hurricanes. Fortunately, knock on wood, not one lately, and hopefully not anytime soon. But when we have them, once that hurricane gets within a certain proximity, and the insurance people have a little chart on the map, a line, once a hurricane goes past that line, guess what? You can't get insurance. The time to be prepared or to act in the event or in the face of a terrorist attack or anything else, bad economic news, labor numbers, Federal Reserve changes, all those things, the time to act is before, not after. Nobody's fast enough, nobody's quick enough, and it's very, very difficult to see around corners, to see what's coming next, right? So what do? The way I recommend doing it is to plan as if that attack, that event, occurs tomorrow. Prepare for it today. There's an old cliche that gets dismissed very often, very quickly. Hope for the best, prepare for the worst. That actually works. Let's say you have 100% of your retirement money in the stock market, be it through mutual funds or your 401k, 403b, 457, whatever your investment accounts are. And let's say that you're a little nervous, appropriately so I would add, but you're a little nervous. What do? You say, well, I'll just kind of see how it goes. If you're a few years away from retirement, I would strongly recommend reevaluating that 100% stock allocation. Maybe you should take half. Take it off the table. Move it into something more secure. Why? Why do that and keep half still in the market? Are we talking out both sides of our mouth? No, not really. Here's why. Let's say you stay 100% in the market, and then you get close to retirement, and we have another 9/11. We have another 2008. We have another market meltdown. Now you're retiring, and you've got a lot less to work with, and you may need to draw on that money, or you may have to delay your retirement. Maybe I need so much money, I don't want to take it out while my account value is down. I'm going to put off my retirement. None of those are good scenarios. What if instead you move, say, half to something more secure, now play the same event, another market meltdown, another tumultuous situation beyond your control. Now you can still retire, or at least work with a strategy where you draw your income from that more secure money. Draw from what has not lost value. You don't have to time or predict the market. You draw from the safe. And what does that do? Well, number one, it helps you avoid having to draw from something that's down in value when you take the money out. You've heard me talk about that. That's called dollar cost ravaging. That's the opposite of dollar cost averaging. It's going to ravage your portfolio. You're having to sell more shares at a lower price at the worst time. Don't do that. Okay? That's the first thing you avoid. And number two, it allows the other money that has been affected to go back up, to recover. Now, the other side of that is, what if the event never happens? You still have half the money invested more aggressively. If that event doesn't happen and instead the market does the exact opposite, which is what it likes to do, personifying it with a personality, it loves to deny or defy what people think it's going to do, right? So let's say instead of a drop, let's say we have something not a terrorist act. Let's say the Federal Reserve does something funky, not expected by the market. Or there's a surprise with the labor market or unemployment or with an election. And the market, instead of being adversely affected as anticipated, it jumps up 20%. You still had half your money invested to take advantage and benefit from that gain. So hedging your bets is not a bad thing. And again, the other thing you can do with this that is more powerful than people realize and has a big role, bigger than most people realize, is the emotional part. If you don't have all your money on the line, you're going to respond differently. You're going to have greater staying power. Your mental health will be better. You will make clearer decisions. Being able to make clear decisions will help you make better decisions. It's not perfect, doesn't guarantee success, but if you've got half on the line instead of all on the line, you're going to look at it differently. If you've got all your money in the market, can you take it easy? Can you not look at the market? I've seen people and heard people tell me they have to look at the market every single day because they've got it all in the market. Is that really how you want to live? So be prepared before, not after the crisis, and that will help you to be a better investor and be better with your investments and help you plan stronger.